Sitting on the far left is Kevin Becker. He is the CEO and Chief Investment Officer at Kiski Group, which is started as a risk management firm several years ago. Oversees, it works with 20 hedge funds and pensions that oversee about 20 billion in assets. But they've also started doing some risk management stuff, launching some hedge funds, which is really cool. He had previously been Chief Investment Officer at Duff Capital Advisors. Before that, Claiborne Group. He founded Claiborne Group, which is a long-short equity fund, ran a long-short equity portfolio at SAC, and used to work at Tiger Management. To his right, Rain Gaisford. He's the Director of Risk Management at Folger Hill Asset Management. He joined Folger Hill at the end of last year to help them start in March. They are a multi-manager long-short equity platform doing cool stuff. Before that, he spent the last few years at Bally Asney, and he had previously been the Chief Risk Officer at Plural Investments. To his right, Vlad Yelisavchuk. Did I do that right? Perfect. Awesome. He is the Chief Investment Officer at Bowery Investment Management, which invests in distressed credit, which he founded in 2012. Before that, he was the founder and co-portfolio manager at Longacre Fund Management from 1998 until 2012. Before that, he had worked in distress claims and loans book at Bear Stearns. And last but not least, Milind Sharma. He is the Chief Investment Officer at QuantZ Capital Management, which he started in 2009 as a quant shop. He had worked at Deutsche Bank under Boaz Weinstein, managing quant portfolios before that. He used to run risk for hundreds of funds at Merrill Lynch Investment Management before it became BlackRock. And I guess started working in this industry at Ernst & Young, where you were doing risk management as well.
That's right.
So a great group here. So Kevin, I'll start you off. And I know you asked me this question when we talked a few days ago. What does risk, I guess, actually mean to you? And what are you looking for when you go in and look at the different funds, pension funds? What risks are you looking at?
It used to be risk management, you can say very glibly, losing money, right? But we don't want to lose money. That's what we don't want to do. I think it's become so much more sophisticated, and there's so many more variables that you need to think about when you're thinking about risk management today, especially at the institutional level. So I happen to personally sit on the risk committee of one of the top North American corporate pension fund plans. And when you think about it from an institutional perspective, it really isn't just about losing money anymore or making sure that you preserve capital and drawdowns and kind of these simplistic set of variables. It's really about how you think about your investment process and how it integrates into the overall portfolio of your investors and what they're trying to accomplish. And when we work with our managers, we're wholly devoted to trying to improve the dispersion of assets in the hedge fund industry by getting institutional capital invested into smaller independent managers. Doing that so the institutions don't have to compromise at all. They should never have to compromise to invest in you. So when you're thinking about your risk management paradigm and thinking about what that actually means, it means understanding your investors. It means understanding what they're trying to accomplish with an allocation to your fund. It means understanding how to explain that and integrate it into your process. So it's a lot bigger, I think, than it used to be. Mm-hmm. It's sort of a simple start-off answer.
Yeah, well, Milind, I'm curious. Your risk, you said, is built into your process. You run a quant shop.
Right.
How do you think about what things to prepare about? What does risk mean to you on that level?
So that's you stated the obvious difference between quants and maybe more fundamental guys, at least in the equity space, is that for a lot of hedge funds and buy-side shops, risk used to be an afterthought. And believe it or not, in '97 when I started Merrill, I was a founding member of Risk. looking back, it sounds kind of shocking that Merrill Lynch didn't have any risk management, at least on the fund management side up until '97, and it took a major debacle, the loss effectively of World Financial South Tower, for them to be motivated to do something on the buy side. But today everyone does it. It's on every ODD sort of checklist. So clearly, it's not the case that hedge funds can opt not to do it. But I still think that a lot of what people call risk management is very superficial, and it's very sort of checkbox driven. We've hired such and such, or we use the Bloomberg risk model or the borrow risk model. It's not really incorporated into their process. Otherwise, it's very hard for me to understand how certain brand name shops that you hear about every day have 25% or 70% drawdowns. I mean, that should never happen. If you have any kind of real risk framework, which we do, and I think most quants generally tend to, because it's in the optimization, it's built in, that we can't violate certain sector, factor, industry, whatever constraints have you, right? And if we say this is it, we're not going to be more than 3% net of such and such, well, it's impossible to exceed that. So we don't need a cop because it's already, it's in the driverless car. You don't need a car. You don't need the cop to check whether the car's going over the speed limit. It can't go any faster.
Right. Vlad, how do you do it? I mean, you're in a distressed space right now. What do you look at when you come in the morning and look at your portfolio?
Well, that's a great question. I would echo some of Kevin's comments. I think risk management needs to be not just deeply integrated in an organization, but I think the portfolio managers, they need to have a philosophical view. What are they trying to accomplish? And other than the more liquid strategies, one of the unique features of credit investing in distressed debt in particular is the criticality of managing illiquidity. And it's a double-edged sword. So we want to be on the right side of that sharp edge. We want to be exploiting others' weaknesses in times of illiquidity. So philosophically, the way we think about it, because there is less liquidity on the long side of our portfolio, is we never want to have to risk manage by selling down positions to reduce gross long exposure. Like that's an absolute, qualifiable principle for us. So we do deep bottoms-up research on all of our positions. They tend to be process-oriented, and it's very destructive to long-term returns if you're trying to manage risk by selling down just to manage volatility. So generally, the long side of our portfolios are kept intact. Each position has a hard catalyst that we understand and manage and occasionally get activist in. And so our risk management involves putting on single name hedges, usually cash instruments, credit, equities, to manage the market volatility of that component of our portfolio. So bottom line is we want to have enough dry powder to buy when there's forced sellers that are doing exactly what we're avoiding.
Well, I want to get back to that liquidity point
Sure.
in a moment. I guess, but finally, let's talk. Rain, I want to talk to you. You are overseeing a portfolio of several managers, trying to get them to all kind of function together. I guess what's key in your mind in making that work?
Well, I mean, the relationship's similar, but it's going to be obviously different. When we're dealing within a multi-manager space, so our portfolio is structured so that we have, at this time, 16 separate portfolio managers, each running a siloed portfolio. They all have their own mandate. So there's a piece of it that is the COP, right? But the COP is very minimal. Like I was talking to someone recently about what percentage of my day is spent on doing that. 2%, maybe 3%. I have computers for that. They monitor limits. The limits that we're enforcing on an individual portfolio manager are very understandable. They're very transparent. People know when they have a position that's getting close to a line. There's not a lot of confusion around that or a lot of necessity for me to go up to them and tap them and say, hey, you're over this limit. They knew they were getting close to it. When it got there, they couldn't buy anymore. No big deal. Much more of what we're doing is helping people understand things. So a portfolio manager, by their nature, is supposed to be a risk manager. Like that's part of what they're supposed to be doing. But maybe they're a risk manager in the way that traditionally they did. They thought about their net limit, or they thought about what sectors they're in, or they thought about these concepts that are not particularly complicated. Don't get me wrong, there's lots of complexity around it, but they were focused on the things that was their day-to-day. My job and my team's job is to assist them in understanding the other things. You know, we joke at a cocktail party is always, I help people understand the bets they didn't realize they were making, right? Like, it's applying frameworks that probably a lot of people in the room are used to. I mean, there was a jab a second ago at Barra. I'm not going to defend them specifically, but more on those types of frameworks can be useful both on the investment process and also later on as a after the trade like risk process to be able to understand, well, you have liens to these things. Do you want that? No. Okay, great. That was a good conversation. We can now do something with that. Right? So my role isn't to go in and say, you must not have this, or you cannot participate in that concept, but more to say, you do have this concept, here's how it looks, here's the risk that that means, here's how much money you could potentially lose because of that. How do you feel? And these people are paid based off the performance of their own portfolio, right? So if they look at it and say, I don't like that, then great, I've started a thing I can help them fix. So a lot of our role in the way that we think about risk management is this advisory function of going to very well-educated, very intelligent professionals and just giving them something they weren't using otherwise and facilitating them to take the next step on it. Yeah, I think I'll, yeah.
Yeah, well, I mean, I want to ask you about the long-short equity space.
Yeah.
One of the things we've seen over the last maybe year or so has been a lot of hedge funds getting hammered by the same trade. You know, whether it's Valiant, whether it's Fannie Mae, on a little more. There were a lot of people in the same trade, and when you're talking to your portfolio manager, saying, "Well, everyone and their best friend has this position," you know. How are you looking at that? How has your thinking changed over the last year?
Well, I mean, it's comical when you're sitting within the multi-manager structure. So where I am now at 16, I was at a firm not long ago where we had more like 50. Within those kind of frameworks, you have a sub-universe of the investment community. So if I have 2 or 3 or 4 portfolio managers or more participating in the same trade, I can use that as a very easy proxy to say, you guys are all doing the same thing. Maybe you came about it from different places, but you're buying the same thing. I don't care what your thesis is. I don't really care what your time horizon is. You own this. Do you all want to own it? Oh, we're not consensus. Yeah, you are. You all own the same stuff. And then we can go out and look at the publicly available data. Okay, the 13F filings say every other major hedge fund owns this. The prime brokers are saying that every other major hedge fund owns this. Do you still think you're not consensus? And just having that dialogue changes people. I don't want to be consensus. I want to have a contrarian view. I want to be doing something that's unique. I want to make money in a way that's not repeatable and is not being done by, or excuse me, not repeatable by other people, but is repeatable by me. I want to be able to go participate in the market in a different way. I'm going to shift my portfolio. So we get a lot. I mean, the term we use internally is moral suasion. I honestly don't even know if that's English or not, but we use it. And we'll simply go up to a group of portfolio managers and say, here's an observation we made. What do you guys want to do? And we won't tell them they have to do anything. We'll point it out, walk out of the room, and then I go start monitoring trading. That guy's trimming a position. That guy's trimming the position. She's trimming the position. Okay, great. We got where we want it, right? Versus you must sell this. If I tell them that, unless it's a hard line like risk has demanded this or the partners have demanded this, then I'm yelling at them and beating them up and changing the whole structure of the dynamic. If I just give them information, allow them to act on it, admittedly it needs to be information that they want to listen to, it does it.
Let me ask a question. And maybe Milin's the best guy because it seems like he stays out of this stuff. I mean, you know, because all 3 of you guys have to participate. You don't have to participate, sorry. There's a set of things that you need to own at some points in time, Netflix, blah, 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 on the equity side, that get you in the club. And if you're playing against the club, how do you manage how do you stay out of the Valiants completely? How do you stay out of, because they do generate a ridiculous amount of return. And same thing goes with the distressed world too. I mean, because Milin's got, would you say you were long volatility and dispersion, right?
Yep.
So I mean, you can't be. I mean, how does that work with your?
Well, I mean, so because in the flagship fund we're market neutral, beta 0, we're not really trying to bet the farm in any one thing, right? We're trying to be generally right across thousands of stocks as opposed to being precisely wrong on Valiant and Platform Special and 3 other names. Right, so we will never be in that type of situation. I mean, we might get lucky occasionally by being short of Valiant, but that's, for the most part, my job is not even to know what tickers we have. In fact, I have no business knowing what we own today. That's not how the process works. My job is to make sure that at the aggregate level, if you've got thousands of stocks, that every factor, sector, any way that you can describe it in sort of a larger space of, characteristics is well controlled. Because at the end of the day, when drawdowns happen or things blow up, like every Amaranth type of situation is because somebody, because the risk department was really just a marketing piece. I mean, it's not that Amaranth didn't have a ton of very good-looking risk managers. They had great resumes. It's just that it's not actually implemented. I mean, many folks don't even measure it correctly. So usually when you have a situation like, the Swissy franc gapped up or down and somebody went out of business, well, obviously, if they'd been measuring their risk, then either they made a very foolish and bold bet, or more likely, which is even more sort of absurd, is that they weren't measuring it correctly. And that happens a lot, is people just don't know what their implicit bets are. You might have only a stock portfolio with 20 names, and you think you have no exposure to FX or oil or something else, and actually you do. And, even the Bloomberg risk model would show you that.
Well, but it's measurement and enforcement, right? So you have plenty of times where people are like, hey, I know what this risk is. I don't care. Or a single manager fund where a portfolio manager says, this is the bet I want. I want to be this massive size in it, versus the risk function actually being able to step in and say, that's too big.
Right.
Which that's the market dynamic of the particular firm that you're at. Obviously, you don't have this problem.
Well, so in that case, what I would say is that there's a huge sort of interplay between idiosyncratic and common factor risk, which people often get confused. They think that all the alpha is in the single name, but they don't recognize that the common factor risk also comes through the single name. Right, so oftentimes you might own, maybe you're not in Herbalife, but you're in the other three, Vitamin Shop and GNC and whatever, right? And trust me, if one of them tanks, the other's also going to be down 15-20%. We just saw that 2 days ago, right? So oftentimes people make this sort of weird asymmetric dissociation of mentally they're justifying their longs. Okay, well, I'm going to make a 10-bagger on this Herbalife or whatever it is on the idiosyncratic bet because I'm the smartest guy in the world who knows the stock best. But, and the fact that the peer is blowing up doesn't affect me.
Well, Kevin, I want to ask you also, what do you see wrong when you first start working with someone, you say, you are really not managing this risk? What's the most common mistake?
I mean, the most common mistake is, what's wrong? Everything. I mean, generally, when we it starts with everything, and then we whittle it down. Because I think mostly, I grew up. I started in this industry in 1996, and and there's still. By the way, we believe in the two men in a Bloomberg model, and we like selling Bloomberg terminals because we think independent thinking is extremely valuable to the institutional world. And the biggest risk that the pensions face and the high net worths face is what we call the 0-0-0 scenario. That's when over 3 years betas contribute nothing but volatility to portfolio returns. And that really kills a pension or an endowment, right? Because they start down every year. They start -8, pretty much, universally start -8. So 0-0-0 from stocks and bonds. So if we woke up in 2019 and the S&P was at 2100 and the 10-year was at 485, no one would say, oh, that's the craziest forecast I've ever heard. But when you're talking to the CEO of a pension fund, that's what lights his hair on fire, because it means that he's gotten zero contribution from his stock portfolio and his bond portfolio on a total return basis over the next 3 years. So what is he looking for? He's looking to capture some of those idiosyncrasies that exist in the market, or inefficiencies. He wants to employ hedge fund managers, which we roughly call hedge fund managers, but active, independent decision makers. Well, in the first round of this technology, the big got bigger because institutional viability was something like, size as a proxy for a firm that can mitigate their non-investment risk. So basically, big was safe on the non-investment side. And track record, of course, was the proxy for, investability, right? So everybody falls victim to that thought process. So the little guy is trying to bang out that track record, right? Because the track record's going to save me. It's a track record that's going to save me. And it's not. We had a manager start with us with $20 million. They're at $500 million because they could articulate their strategy. We had a guy start with $20 million who's at $900 million because he can articulate his strategy. And you articulate your strategy and your risk management concurrently. So what's wrong? What's wrong is that people don't understand that track record is not a proxy for your investment process efficiency. You don't get that when you're small. You start to think it's just, I got to make a lot of money, That's not really what the game is about. The game is about being able to articulate your risk management as a part of your process. These guys are great at it, right? These three guys are perfect examples of being able to, great examples of being able to articulate the sort of how the risk management fits into the strategy. And if you can't do that, you're going to lose. You're going to be one of the 875 guys that are, under $100 million of assets who are going to go out of business this year. That's it. So simple, straightforward answer, I suppose, to that question.
All right, shifting gears a little bit. Sorry. Vlad, I want to talk to you about, there just hasn't been a ton of stuff to do in the distressed space, big distressed situations. So we've seen a lot of people end up in the TXUs, the Puerto Ricos, a handful of names.
Right, exactly.
If you're trying to target, smaller names, then you have this liquidity problem. How are you kind of navigating that, and what risks are you okay with taking, and what ones do you not want to take?
Well, I think position sizing is possibly one of the biggest decisions, one of the most important decisions a portfolio manager can make in credit, and especially distressed. So just touching on a point that Kevin was making about what I think I heard you say about the crowdedness of trades and what's the risk of having crowded trades and correlations. I think those risks are even greater in the distressed debt strategy, and there's two main reasons for it, and they both go to the structure of the market. Reason number one is, and they both stem from approximately the time of the global financial crisis. Reason number one is there's been a really significant increase in the concentration of distressed AUM held by a relatively small group of managers. So today, 13 managers control 65% of all distressed AUM. We obviously know who they are. I don't want to hold anything against them, but they generally look at things the same way, and they think of things the same way. And even if they wanted to differentiate, their sheer size in a crowded market prevents them from having differentiated portfolios. So you're exactly right. They all own Lehman, usually their number one or two position. They all own TXU, maybe the third, fourth, or fifth largest position. They frequently will own Puerto Rico bonds because they essentially become quasi-index strategies just because of the mismatch between their AUM, the concentration, and what's available. So Bowery has the advantage of being simply smaller. So our greatest structural advantage is our smaller AUM size, which we fully exploit. Liquidity is critical to understand. One of the features of debt trading, especially distressed debt, it's still a voice telephonic market. It's not automated. And so there's valuable color and market intelligence that we can glean by having great relationships with brokers and intermediaries and treating them well, and just understanding how best to work with them. The other structural change is the banks themselves, obviously because of regulatory changes and business practices since the global financial crisis. The street doesn't intermediate. There's no market maker function. Even large bank trading desks, the amount of capital has been minimized, and the way they trade is completely different. It's essentially an order matching process rather than a true market making process. And so what does that mean? That means that there's significant friction, particularly when there's some type of an exogenous shock or news event. All those distressed managers, generally similar DNA, looking at risk the same way you've all heard the analogy, like they're either like all running to one side of the ship and tipping it to the left, or they're running to the other side of the ship and tipping it to the right. And so we're very cognizant of that, and that's really critical to our process. And so the way we manage that is we end up having a very differentiated portfolio. We find great middle market and niche positions that aren't kind of tossed around by fund flows or changes in the sentiment of a relatively small group of large managers.
Well, but by the same token, there's just aren't that many people that hold that stuff. So what if, one other large holder of some credit that you own kind of gets out? Isn't the price of that just going to collapse, and then you have to go and explain to investors, no, well, we're going to hold it.
Potentially, but what we find happening in the market, the way most distressed portfolio managers behave, is if they need to reduce risk and take down their long positions for whatever reason, just price risk management or managing redemptions, they will sell what's liquid first. And so if there's a liquid bond that's marked at 80 and things go wrong and markets sell off and they can sell it at 79, they're going to sell that bond. If there's a different, less liquid bond at 60, that's very difficult to sell. Maybe if they have to hit a liquidity bid, it's a 55 or 52 bid, they're not likely to lean on that position and sell it. So there is that feature of that advantage of being in some of the smaller names that aren't as affected by fund flows. The other thing that we are very careful of is just simply position sizing. So if there's real illiquidity in positions, we make sure it's not an excessive amount of our portfolio. And we also try to get as much intelligence on who else owns what we own, and we look for weak hands and strong hands and then size it accordingly. But also, virtually everything that we own has hard catalyst associated with it. So either it's in a Chapter 11 process and it'll reorganize out into something potentially more liquid, or it's a liquidation process where an illiquid position will convert into cash, or there's an M&A exit to it.
Okay, and I think that might have gotten a little bit to it at an answer we had from Milton Lewin and Scott's Cove in the audience. You mentioned that you hedge by going short single names against specific long positions, but given how idiosyncratic most of your longs are, how do you avoid the material basis risk? I don't know if you have anything to add on that.
Well, I think by definition, it's essentially not possible to hedge out process risk. And so we don't attempt to do that, but the risk that we're trying to mitigate is the price risk that's associated with general market conditions or exogenous market-related shock events, not individual process risk. I mean, we believe we're experts in understanding, managing, evaluating individual process risks. When we've gone and back-tested our performance and been very self-critical, we find that the mistakes that we've made in the past tend to be not sufficiently understanding the relationship of the portfolio based on exogenous risk. We make far fewer errors on individual name-by-name process risk.
Okay. Raina, I want to ask you a question, and this kind of comes from something in the audience, but also just generally. In August, a lot of folks were talking about risk premia strategies. And ETFs just kind of moving through the market. I'm sure a bunch of you can probably talk about this in each of your respective places, but how is that changing the thinking? Are these strategies actually having an effect, or are they, you're just, the big movements of money?
So I have theories, and I'd love to hear if someone has a better theory, but the theories that we've been running with is around effectively these very large pools of money that are not motivated directly by returns, but instead motivated by hitting volatility profiles, then reshifting their portfolios because of shifts in volatility in the markets. So we observe VIX and other volatility measures gapping, and then we observe people selling equities, and it being a one stepping into the other, stepping into the other, as opposed to fundamental views on individual names, or as opposed to even trading in one sector versus another, but simply exiting from equity positions and then driving it down and then seeing, okay, now that a volatility level is stabilized and a relatively straightforward math problem around a hypothetical portfolio with X volatility target and Y vol of equity and Z-vol of another asset class, okay, we've hit now a level where it's stabilized again and the selling decreases, right? So I've heard this theory presented by a number of people on the sell side. Internally, it seemed to be reasonable, and so we've been running with that as a new part of the new world, in that now there's these massive piles of money that are being run in this return agnostic space, trying to hit vol targets. I would expect this pops up in your world quite a bit, or maybe a little bit. But
I'm not guilty of it.
I'm not saying you are. More,
I just point a finger at me.
No. Sorry. I
the guy
imagine
who's
this
causing the
more in
market
the. It is. It's all more in the pension fund endowment space, things like that, looking to target these kind of vehicles. But sorry, that was
No. I mean, I think the pensions are smarter. Look, there's plenty of stuff going on out there in retail world, especially where we're liquid alts. I mean, there's lots of people trying to attack the fiduciary space. There's a whole bunch of stuff that's going on. The consultants have an evolving business model. Everybody wants the large pools of capital. I think we tend to work with very progressive pension organizations. I mean, so the kind of non-consultant pension organizations, and I think they're thinking about things pretty well. I mean, there's a kind of the thought leadership group in the pension world is pretty interesting, and there's some people who are doing a job that that's sort of thankless. And and it's funny that you mentioned this kind of return agnostic hitting the vol thing, because one of the issues that we find we have to explain to managers all the time is we're sitting across the table from an allocator. The allocator's not there to make more money. Like, they don't care about your plus 25 year. They just don't care about it. They're there to be able to explain what they did with their money. So their job is sort of, this kind of communication job. And the reason that their job is so hard is the people that they're allocating money to generally don't give them any credit for that. So we think these poor, brown loafered, hush puppy wearing pension fund guys who bring their own water to a meeting because they can't take anything from you, are kind of slow and dim-witted. And you're like, well, no, they have this really hard job. And the hard job is being able to take what you do and explain it to the people to whom they report. And then the worst a manifestation of that is what Rain's talking about, where you basically come out and you're saying, okay, I just have a target and I kind of have to get there because I have a difficult time explaining it. The more progressive and best manifestation of that are good allocators who can allocate money to independent thinkers, establish a portfolio of them, figure out how to capture market inefficiencies for their own portfolios, and then fight that 0-0-0 scenario by making other sources of return and allocating to them. So, I mean, there's kind of, there's kind of the dumb, kind of unthinking money, and then there's the sort of progressive money, and the two things are probably, at odds with each other, but which is what creates opportunity for Folger Hill.
Yes, it does.
Well, Vlad, I want to talk about this in your space as well.
Sure.
I'm certainly, what is it, nearly 20% of the high yield index is energy, and
That's
so
right.
so you're watching all high yield sell off, and where do you come at this? How is this changing the game for you? And if you could describe an example or somehow you're able to take advantage of that.
Yeah, sure. I mean, I think when we look at the history of the high yield market, what's happening in energy now is very reminiscent of what happened with technology, media, telecom, post-telecom bust in 2000, where then as now, the difficulty stemmed from having the largest sector in the index be the most distressed. So back in early 2000, TMT was the largest sector in the high yield market. It was the most distressed. The telecom sub-sector had absolutely horrible performance. I think in 3 consecutive years from 2000 through 2002, it returned something like negative 47%. And over that 3 period for that subsector, about 75% of all issuers defaulted. Either it was a payment default or it was a distressed exchange that resulted in a permanent loss in principle. So having the largest sector be in such a state of distress weighs very heavily on the entire index. Now we're seeing the same thing. Energy, and mining is weighing very heavily on the entire market. So the easiest way to exploit that short term is just simply to look for the babies that are being thrown out with the bathwater. And there are plenty of those, right now where managers are de-risking. Flows have been out of high yield the last several weeks, and they're just simply forced selling or uneconomic selling, which is really, it's music to our ears. I mean, it's exactly sort of what the raison d'etre is of distressed, is we're here buying when other long-only investors are selling for uneconomic reasons.
That's a little risky business, because when you look at your numbers on a month-to-month bit, and when investors call you and say, I don't know about that, what I guess what's the conversation? How distressed do things need to be that you feel comfortable taking the risk that they could go a little farther?
It's difficult to predict exactly how far things can go, but we're seeing value right now. The distressed returns, they've been under pressure because the process of creating distressed opportunities is painful by definition. Things have to trade down to get to a point where they become really interesting. Defaults have to occur, bankruptcies have to occur to really cause capitulation selling, but that's when really like the greatest opportunities manifest themselves. So it's difficult to predict the timing, but the credit cycle has turned. QE3 is obviously a thing of the past. It's a distant memory. We're sort of counting the months to Fed liftoff as a result of the difficulties, not just led by energy and mining, but not just energy and mining. There's lots of problems and growing problems in the retail sector, in telecom. As a result of all these things, the market is cheapening and will be presenting significant opportunities.
All right, and I would just remind everyone in the audience, do submit your questions to it via the app, which is great. We have a couple people who are submitting a lot of questions. So, but most of you are not, so you should. I want to get back to the idea of ETFs and this more passive money. Can you tell me a little bit about kind of the risks you see there for a portfolio that...
Yeah, I wanted to touch on the same sort of risk premia / liquid alt / ETF space, which clearly seems to be front and center these days. Everyone wants to get involved, which, on the one hand, there's some cannibalization of fees. On the other hand, I think it also leads to a situation where the largest managers, and he hinted at that earlier, that the largest managers who are effectively indexed, right? I mean, for all practical purposes, they are running risk premia portfolios, okay? And they're not really taking active risk and adding any value, so they might as well just call a spade and charge ETF type of fees for instead of 2 and 20, because the smaller guys, I mean, some of us who are nimble enough can really add alpha. The really large funds, they're just sitting there, okay, deep value, just, so buy the value ETF, risk premia factor, or whatever you want to call it, right? Mm-hmm. However, this does present another problem, right, which is the fact that you've already got tens of thousands of mutual funds and tens of thousands of hedge funds and ETFs, and now you're going to have a whole bunch of the risk premia index ETF related products. So I think this leads to what's called the paradox of choice. It's a problem well studied in psychology. It's becoming more and more sort of visible in the sense that, in a consumeristic economy where you have 400 choices on the grocery shelves, I mean, at some point people just get paralyzed, right? I mean, oh my God, which cereal am I going to choose? I can't make a breakfast decision. Oh, what should I wear today? I got 4,000 suits to pick from. Well, so at the end of the day, a lot of 401ks never get invested. A lot of IRAs, people just don't pull the trigger because they look at the statements, they look at the menu choices, and they're just totally overwhelmed. And what I'm actually suggesting is that the world would benefit tremendously from simplicity, not from, excessive choice and a very confusing array of choices where nothing's standardized, the fees are not standardized, the disclosure is not standardized. So, at the end of the day, at least in the retail world, people end up making really sort of unwise choices because of all that. And that's where I think active managers actually can justify their their existence rather well, because, you know, someone who's doing a good job of rotating and tilting and sort of dynamically levering different types of risk premia, even if they don't have a completely unique source of alpha, the fact that they're doing something different with risk premia is a value added. That justifies 2 and 20. But just saying I'm the 3,000th guy to read, you know, Graham and Dodd, and I'm going to implement a deep value strategy. Well, guess what? Your 8th grader with Yahoo Finance can do that better these days, because they can all run a PE screen, right? I mean, anyone with a Bloomberg can run a PE screen, and they can come up with the same answer as Warren Buffett, or probably better, because, you know. So.
We have a question from you, for you from the audience. Comes from Timothy Chow at Voyant Capital Management. You mentioned that you control for risk automatically by trying to have near zero exposure to all the factors. You know, how do you manage the risk of crowding in the quant space? August 2007, do you have an automated process for this? And I know we also discussed that there was, even in early October, there was
That's right.
a quant shakeout. So if you could, A, tell us a little bit about what happened in October, and B, kind of answer that question.
It was an excellent question, Timothy. So, you know, Timothy's hinting at the sort of mini quant meltdown back in August 07, which has stayed in the memory of, in the institutional memory. A lot of people ask us about that. Hardly ever does an ODD go by without people bringing that up. And, you know, of course, what a lot of people don't seem to recall, because the media really overplayed that 1 week drawdown, is that many quant managers actually ended up the month. Some of them didn't. Some of them were down 40%, and you know, that's you should expect some dispersion in the space. But I think what that episode really brought about is similar to some of the issues perhaps in distressed land, is that if you've got a few very concentrated sort of large players that have a disproportionate amount of the assets, which at the time in the quant world there were a few large funds that don't exist anymore. You can guess who they might be, had 40% drawdowns, because they all had very similar positions. These were genuinely crowded trades, and they'd been doing so well for such a long period of time. They were massively levered, and they got complacent. And then eventually, when this little shakeout happened, which rather interestingly was never a stat arb shakeout to start with, it was actually a credit shakeout precipitated by credit toward the end of July, and the multi-strats had to redeem from their cash machine. The cash machine was stat arb, and so they got the redemption notices, and you know, the prop desks as well, from a VAR sort of ex-post VAR control perspective, and they got tapped on the shoulder, hey, cut your exposure. And so then, you know, if gigantic fund A starts liquidating, he's effectively shooting at B's positions. B looks at his risk exploding and his drawdown, and he starts selling his position, and then, you know, back to A, and he's like, oh my God, this is down another 10%, I better cut by. So you can imagine what happened. But amazingly, when the selling stopped, and this was probably like 2 o'clock on the day that Jim Simons did his mea culpa in CNBC, and, you know, Goldman rescued their fund. I'm sure some of you remember that fateful day. It was a massive, gigantic U-turn intraday, and like every single stock that had been getting trashed was up like 30-40% intraday. So it was clear like night and day that all the drawdown was caused by forced selling. It wasn't anything fundamental. And if you were able to hold on to your positions, you saw them snap back so dramatically that, you know, anyone playing mean reversion, that was like the best day in the history of stat arb. So, I mean, if you had kept your positions, you would have probably made 10-11% in one day. With some leverage, you might have made 20 or 30. So it literally was the best day in the history of stat arb. Fast forward to October this year, and the first week of October, once again, we saw some funds, some stat arb funds got hit, not 40%, but maybe, you know, 6, 7, 8%. Again, to me, that means that there's still some crowded trades. The amount of AUM in the space is significantly lower. Those players don't exist anymore. It's much more dispersed. So the reason it wasn't as big is because it's not like 3 big funds that are dramatically, you know, liquidating. We had almost no impact, 20 basis points. We actually didn't notice. I was told at a party on a Friday night by a stat arb manager, oh, what did you guys think? And I was like, about what? Because the reason being that our algos have long since adapted. I mean, obviously you try to adjust for the stuff that you saw yesterday, right? I mean, you can at least fight yesterday's battle and make sure you won those, even if you can't anticipate every future one. But it's surprising to me that a lot of systems haven't adapted because of this type of behavior. And of course, it's very pernicious, but it happens not just in quant, I might add. It happens actually a lot in most strategies like deep value, where everyone picks the right. Everyone thinks such and such stock is really cheap, and they all go piling in, and then it becomes a falling knife.
But you've changed. So you've gone in and tweaked the strategy a little bit. Said
Yes.
We don't want to be the ones that are selling off.
You got it. And the right way to do that is ex ante, right? Because once the liquidation episode begins, then you're no longer in the driver's seat, right? Because then the only choice you have is not to cut risk, which is actually a pretty dangerous choice. That's not a good place to be left in. So the only way to manage it is ex ante, where you design the process so that you never get greedy in the first place. You don't want to do things I was sort of perhaps slamming certain risk models that are very commonly used, and it's an interesting unintended consequence of the way that the whole institutional investing space is designed, that everybody expects you to have such and such risk model to check their box. Well, guess what? The danger of doing that is that if everyone in the world starts using that risk model, and they have, even if their alphas are different, if they all use the same risk model and same quadratic optimizer, it'll eat up the alpha, put you in the same positions, and then you have a liquidation episode. So the obvious thing, and I'm not going to tell you the answer, but there's some pretty obvious ways to fix that. There's much fancier ways to fix that with AI and machine learning and stuff that sort of learns effectively. But the simple way, the commonsensical way, is, hey, if you know everyone's doing that, don't do it.
Seems simple.
I want to move to Rain for a second here. One of the things that I guess we've seen in our reporting on hedge funds, and probably you guys are expecting, is there going to be some redemptions at the end of the year from various hedge funds, and things are going to move around a little bit. Are you talking to managers at all about preparing for this end of year moment?
At our fund?
Mm-hmm. No, not like you guys are whatever.
No,
but generally the industry.
Capital's just coming in.
Excuse me.
I mean, no, I don't have a specific comment on it about preparing for this particular year and being large-scale shifts around it. The firms that I've observed, the multi-manager space is very well-liked at this stage. There was a major competitor in the space that is no longer a hedge fund, and therefore there was an awful lot of capital that left that firm and has been moving into other places. So my previous firm grew quite a lot in the last few years. The place where I am now, we were able to launch pretty successfully with over $1 billion, so those give a lot of people coming into the space. And there's continued interest in adding into this type of profile because it gets you the liquidity profile of a single manager equity business with a lower vol profile and a more diversification. So a lot of people are looking to come into it. As far as other managers shifting around, things like that, no, I'm sorry, I don't have a specific comment on it. But I'll take the money if anybody's looking to reallocate. Let me know.
Or are you, I guess, advising your managers lower down to be cognizant of the fact that this is happening?
Well,
It might happen.
yeah, I mean, the thing I can speak to more on that is we, as a risk committee within the firm, we obviously are allocating capital to people who will work for us. And we have regular conversations with them around, okay, we've now reevaluated your risk profile. You've now worked with us for a longer period of time. We know what your returns have looked like. We know what your potential returns for the future based off risk assumptions, et cetera, look like. We need to move things around and be more nimble to be able to structure the book that we want to have going into next year. That's nothing to say that myself or the partners at my firm are out there predicting we think this sector will outperform that sector. If we had that view, we would go trade ETFs or trade some sector-specific position. Much more around, okay, I had the history with this portfolio manager. I know what their profile looks like. I know how sustainable and repeatable their process is. I know how much their returns came from alpha versus sector-specific bets or style-specific bets, or whether they just had one idiosyncratic amazing play, but then I don't expect them to repeat that tomorrow. Okay, great. I'm going to allocate them capital based off of that expertise, as opposed to just saying, okay, we're going to keep everyone the same and we're going to run the whole thing. We do have within that conversations with our own portfolio managers around there are points in time where we will be adding to or reducing exposures. You need to be prepared for that and plan for that. But then our liquidity profile is very different from like the credit books that we're talking about. Long short equity. I mean, some base level derivatives. We're trading, puts and calls. None of this is anything that we can't sell or shift around relatively easily. We're not taking large illiquid positions in microcap companies. We're trading in large cap, mega cap, and we're trading in liquidity profiles that if we need to get out of a position, it's days at most. And that's with caveats for participation rates and things like that. So it's not something where we have to have our teams prep weeks in advance for a known capital reduction. We can simply say, okay, it's coming up, get ready, okay, tomorrow you need to have a significant cut, a few days later a chunk more. And just to be clear, I'm speaking purely in hypotheticals. If any of my portfolio manager are listening, we're not talking about your book. Everything's fine.
Well, Vlad, I want to get to you. There are. I guess, are you worried coming up at the end of the year, not from your fund specifically, but from other funds out there, that there's going to be a sell-off of things generally?
Yeah.
And are you preparing for that?
Absolutely. I mean, we have adequate liquidity to take advantage of other people's forced sellings. I think we're seeing that. I think we're in the midst of it right now. I mean, just look at the high yield market. It's the total return on the index is down about 2.5%. Year to date. It's the first negative return in high yield since 2008. So, clearly there's a lot of concern in the market about the structure of credit and potential returns going forward. I mean, our view is high yield will probably return less than its coupon, something positive we expect in 2016, but less than its coupon. But absolutely, that year-end repositioning and sell-off and liquidity building, it's happening now.
It's happening already. Okay.
It's happening right now, yeah. And we've been bidding and taking advantage of that.
Okay. Kevin, on the hedge funds that you advise, are you trying are you getting them to look at things differently right now as we go into the end of the year?
No, I think there's always the risk. I mean, I used to love when I traded at SAC, the tax loss selling season and all. There's all these little micro strategies that you have that you deal with. I think, I like the combination of Milind and his point about, what's everybody doing. And what everybody's done is they piled into large managers, and that's starting to have its obvious, the obvious weaknesses of that is starting to show up in the institutional market. And obviously, everyone's piled into the multi-manager space, which is a great benefit to Folger Hill, and folks like those guys are doing a great job with that. So I am a born and dyed-in-the-wool contrarian, so I'm doing exactly the opposite. And I think that keeping managers independent and having independent thinkers start to receive allocations of capital from institutional portfolio managers is the right answer, not to have a risk mill where everybody sits in the same room. I did that 20 years ago, whatever, at SAC with the headset and whatever. But I mean, now I think that there's a real reason to sort of have managers stay independent. And I think if you can weather the storm, and if you're realistic about your economics, and you think because the remuneration's coming down, and what the institutions want are lower fees, because the high fees, are not making. I think somebody told me the other day, CalPERS did their analysis. 87% of the fees that they paid were management fees in their hedge fund portfolio, and when they looked at their historical. So we're not telling anybody to trade differently right now. I think everyone's got to pay attention on a day-to-day basis. But I think it is, prepare, because I do believe that the independent asset manager, active asset manager, as again Milind pointed out, has value to add to the institutional portfolios, but you just have to make sure that the institution doesn't have to compromise to put money with you. And that is the kind of our overarching message to all of our managers is, unless you want to end up with a headset on at a desk working for somebody else, who's aggregating capital on your behalf, if you want to remain independent, there's a list of things you need to do. You have to hold your nose and do it. And I think if you do it, you're going to benefit from what I think is a reversion to the mean in the marketplace of, institutions wanting to invest in these smaller guys.
Well, I want to see if there are any folks who don't have access to this app out there in the audience who have questions. Right in the front row. There you go.
want to ask you, I mean, you talk a lot about qualitative. Can you talk a little bit about quantitative measures of risk? What are the risk metrics that you use right now? Because they change. And if I get it right, Kevin, you're probably the only one that you allocate to multi-managers. And how do you manage the risk in a multi-manager portfolio?
So I think Rain allocates to
Well,
multi-managers.
Internally, yeah.
Yeah, and we have a bunch of managers on the platform, so maybe I'll let you answer that. You answer that question.
Sure. I mean, so quantitatively, what kind of metrics are we looking at? I mean, we do use a factor model. We also use a lot of information from the options market. So we'll look at individual volatilities of names and then re-aggregate that back up. So a lot of what we're trying to do is come up with an assumption around the volatility of both our portfolio managers and the book, right, the total firm. So we'll look at historical volatilities of names, but then we'll also look at implied volatilities of those names, use that data as an input into our future expectation of volatility of an individual name, and then mathematically bring that up to the portfolio to say, now I have an expectation of the future volatility of the portfolio, both for an individual manager and for the firm. And I can also compare that against what the realized or historical volatilities would have been for that portfolio. So we're able to see a forward-looking expectation of volatility, a historical expectation of volatility, both with a similar kind of framework, as well as a factor model's perspective on the portfolio, and look at them all in unison. Right? At any given time, one model only tells you what it knows. It doesn't necessarily tell you the answer. Right? But by using a couple of different models and a couple different frameworks together, my expectation is that we'll have, when there's a divergent, this model says everything's fine, this model says something horrible is going on, that's when we'll look into it and try to figure out whether it's the model being broken or whether or not that really is indicating something that part of the rest of the market isn't picking up yet.
So the risk metric is volatility. Are there any other risk metrics that you use, or you're still volatility?
I mean, correlation, I try to avoid VAR for my particular portfolio because we're single asset class, so I'm not as concerned with that. But yeah, I mean,
if I can jump in. So just a brief sort of primer on the evolution of risk models. I mean, in the mid 90s, a lot of this stuff was covariance matrix based. I mean, that's how the whole space grew up. You took a bunch of factors and you try to minimize the dimensionality of the problem, and this was all driven by, at the time, BIS Fed type of requirements that the bank has to have a VAR number. Later on, people started doing similar things in the buy side in terms of what used to be called tracking error or active risk. So that was the standard thing. Interestingly, while some of the underlying technology has evolved quite a bit, that you can do Monte Carlo, or you can do, it doesn't have to be parametric distributional assumptions. You can vary that. You can do all kinds of little tricks with that. But the overall infrastructure framework hasn't actually changed much. So the innovation in the risk space has completely plateaued out. Because everyone's now got a covariance matrix. Everyone has some kind of VAR and an expected shortfall, which essentially quantifies it's sort of the mean of the tail, if you will. Everyone has access to some correlation number, even if they don't understand that it's highly unstable and it may not mean a whole heck of a lot, because you have to know what the false positives in your covariance matrix are, if they're really stable, what the half-life is, and there's a lot of caveats that go into these, but people use the number because they have to. And despite all of that, my real point to you is that if the set of securities and instruments that you run it on, it's not 10 stocks or 20 stocks, in the limit, all the stuff is actually pretty reasonable. Most of these risk models do actually make sense because the risk numbers are very stable on large portfolios compared to expected return estimates. However, they're almost entirely useless in the tails. So when it comes to higher moment risk, when you're talking about kurtosis and higher moments, that's a whole different story. So the classic risk models, which have now plateaued out and have done a reasonable job at the base level, everyone's got one. They're pretty much useless when it comes to the higher moments. So even this standard stuff, Sharpe ratio, all of that, I have an old paper 11 years ago fixing the Sharpe ratio if you're into higher moments. That is still an area of research. So you can look at tons of things like Sharpe and Sortino and Kalmar and this and that, and they're all good to look at. And if you're into risk models, I'd suggest using at least 2 or 3 of them, not one. That's your best insurance against.
Well, I want to ask, because we are out of time, I just want to ask, 1-word or 2-word answers. What is the thing? It can be some topic we discussed today or something else. What is the thing that keeps you up at night? What risk are you constantly worried about? either in the markets or structure or whatever. Kevin, go.
Liquidity structure of the market.
Rain?
Yeah, I'm going to stick with the same thing that the market dynamics shifting in a way that we're totally unprepared for.
I'm going to say just exogenous shock that just causes worldwide sell-off in risk assets.
We're long vol and long dispersion. We like risk. Our only worry is that Fed or ECB might kill risk, but the more the better.
Well, great. Well, thank you guys so much for being with us. I think this is great.